Hello, everyone. Welcome to the next episode, a new episode of my podcast. Today, we have Charles with us in Bibek Talks, and we are really excited. So, the basic topic today is all about investing and evaluating a company. Charles Sir have written and recently published his first book. So, he will be telling about his book and giving us some view on investing and motivating us as well. So, how are you doing, Charles Sir?
Yeah, doing very well. Thanks. Yourself?
Yes, I absolutely doing good. And good to see you here.
Yeah, no, thanks for having me on.
Thank you so much. My pleasure. So, can you just get started with you a bit of introductions here?
Yeah, sure. So I've got just over a decade of experience in financial services. I used to work at a firm called Jupiter Asset Management, which is a London-listed fund management firm. There, I was a fund manager on the Jupiter Emerging Frontier and Income Trust, which is a London-listed income trust for those interested. And then more recently, I've been writing this book, the Company Valuation Playbook.
Really good to know that. And your book has already been published, am I right? Sir?
Yes, yeah.
So I will be linking the book description in the description. I'll just leave a link. You please check everyone, okay? I hope so. Everyone is going to check that out. So can you just tell us about a bit more about your book so that our audience can get more idea?
Yeah, sure. I got a copy just here, actually. So
That's really look nice.
Yeah, so it's called the Company Valuation Playbook. And I wrote it very much due to my own frustrated experience trying to learn about how to value a company. You'll find there's kind of plenty very kind of academic answers. What I've tried to do really here is make very practical, quite concise, quite interesting, with plenty of anecdotes and illustrations and examples to try and bring what can be quite a dry topic to life. So it's got, for example, quite a few pictures in here for those that kind of learn visually rather than simply reading through text of prep book.
Sounds really great. So the main concept is to explain people about the terminology of finance in a simple language.
Yes, yeah, exactly. I've split it up into kind of 5 different sections, kind of how to assess, so how to use kind of quantitative methods and qualitative methods to understand the forces that affect a company. Then how to project, so from a very simple kind of headline projection to being able to develop a full financial statement model and DCF output. Then pricing, so using relative and intrinsic valuation methods. And then finally, how to profit, so the idea of assess, project, price and profit. And that final one is more just kind of how you would typically go about investing in a company and how you avoid some of the behavioural bias errors which plague so many of us.
So can you just define a bit more about behavior bias, a bit more detailed, I guess?
Yeah, sure. I think this is one of the more interesting areas of the book, actually. And because at the end of the day, we're all very much human investors also. And we bring with ourselves kind of very much our own baggage, be that kind of emotional biases or more quantitative biases. And there's a number of ways that manifests itself. So, for instance, a very basic one is anchoring, for example. Simply to buy something at a certain valuation level, we think kind of we receive all our subsequent returns relative to that anchor. And rather than saying fundamentally this is what it could be worth, we look at that anchor and think of profit and loss. It's a bit like you quite often get companies that say something's trade, like you can buy something at a 20% discount and you think, wow, that's great, I'm going to go and buy it. When actually it may have just been overpriced to start with.
Exactly.
And I go through kind of about 10 examples of these in the book, the different kind of stages of biases and how you can go and the methods that you can use to be able to avoid them and kind of take a more objective appraisal of a company's value.
That sounds really good. So you have described it in more brief in your book as well about the behavior bias. That's really nice. So how important it is to understand, listening to you, it sounds that you're using some of the terminologies of accounts as well. So what do you think, how important it is to understand account when you are starting to invest?
I think a lot of people get put off investing because accounting can look quite complex and numbers oriented. And I think that's absolutely fair. And the truth, in my view, is that you don't have to have a kind of black belt in accounting to get into investing. like actually the basics are very simple. You've got a kind of profit and loss account, your income statement, where you have
Balancing sheets.
and profit, the balance sheet, kind of where, and beyond that, you don't really need to know the kind of nuances. There's plenty of nuances to accounting, but in most cases, that those don't really have a huge impact on the end outcome. So I've tried to make it as simple as possible, and also importantly, I've put in the box in the book plenty of ways that you can standardize numbers. So you don't need to go and remember, I don't know, what the gross profit was in this year, that year, and the other year. It's about standardizing it into a margin, or equally with return. Um, Profitability, looking at profitability as the return on equity, a percentage number, rather than an absolute figure.
Sounds really great. I'm getting excited to read that. Hope I'm going to complete download that. Is that book available? Where can I just get that book? Your book?
So at the moment, it's available only on Amazon. I'm looking to expand that, of course. I will be putting out an ebook, but and a hardback copy as well. But to be honest, the paperback, I think, is the best one to buy. It's
Exactly.
cheaper than the hardback, and it's a bit more. It's easier to go through and like write notes.
I guess you can go for the ebook as well, because many of the audience are from India and Nepal. So these are the countries where the Amazon are not working so good. So you can just go with the ebook, so that can help for the audience.
Oh, but if I'm going to get, is it Flipkart is still about India?
No, I'm not getting you. I'm really sorry.
Oh, I was going to say, is it Flipkart in India, the online commerce company?
Flipkart, yes, the Flipkart is very famous. Amazon is very famous as well, but I don't think. Can you ship that book to all over the country, internationally, or no?
Well, in any case, I'll guess
So
an
then
ebook.
that's okay. Then that's okay. Like Amazon is working very well. The problem was just shipping about and all. That's good then.
Yeah.
Exactly. So what are the potential, sectors or opportunities you're looking? Like if you just look at in this scenario, Bitcoins, Ethereums, and other kind of investment opportunities are booming right now. So what is your vision? You're looking forward for 10 years or 5 years.
Yeah. Well, the asset class I like the best is equities. With equity, with things like Bitcoins, there's very much a winner and loser, and it's quite black and white in that respect. Equities, on the other hand, equities do go up over time. A lot of companies will pay you a dividend, and historically,
Exactly.
equity markets have grown. So it's not a case of you're buying something and somebody else may lose. It's kind of we should all hopefully go up together. So that's certainly my most preferable asset class. I mean, personally, I look at a lot of emerging markets opportunities. I think that's where many of the most compelling growth opportunities are. And even now, I think you can still quite find kind of interesting ideas at the same time as being disciplined in valuation. It perhaps goes without saying, not always a good company is a good investment. And I think this quite often gets forgotten, and you start to get into bubble territory when people just plow into a company because it's good without thinking about fundamentally what are the returns this company will generate for shareholders. Because the company should be seen as far more than a kind of a piece of paper that's traded around it. It reflects it reflects a right as a shareholder to receive the kind of dividends of a company and benefit from those profits.
That's great. Exactly. I'm strongly agree with the point. At least we need to know what is the basics, why this asset price is going up, coming down. And in the case of Bitcoin, it is very hard to understand why that is going high, why that is coming down. That's all about behavior bias, you can say. The people's sentiment is really connected in this cryptocurrencies, and they're fluctuating each day. Just by a small tweet done by Elon Musk or something. So
Yes.
definitely it is quite riskful.
Yeah.
So what is the reason behind a podcast and books? What was the journey behind that?
Yeah, I think podcasts is a great medium. I use podcasts myself, and your own field. I think it should be one that could be interesting, certainly for your listeners. I mean, I think generally investing and finance more broadly is so much more applicable to people's lives than they might think, especially if you start early in your life.
Exactly.
You can, with your savings, you can accumulate really quite good wealth. You should always try and make your money work for you. It's a bit of a cliche, but there's only so many hours in the day that you can really sell your work. And so investing your money, you can really kind of quickly accumulate returns
Definitely.
by doing
So that is the reason you want to make people aware financially. So that is the reason you started podcasting. That's really so nice of you that you want to share the knowledge and make everyone financially freedom as soon as possible. So what
Yeah,
are the
hopefully.
more? Please go for that.
All right. I was just also going to say, actually, I think it's often overlooked that there is a great social benefit to taking a fundamental approach to investing. There's plenty of speculators out there,
Exactly.
short-term buyers and sellers, and there's no real value when you do that. And I include kind of society value in that as well. So first, for the individual, it can often be very dangerous when you get things wrong. Taking that type of approach. And then for society, if you take a fundamental approach to investing and properly valuing a company, you can help your kind of entrepreneurs, etc., know how to allocate capital. And so I think there are kind of broader benefits for a society when you get kind of greater parts of the population taking a genuine interest into
In
enterprise.
investing, rather than just buying in the morning and just selling in the evening.
Yeah.
So, listening to you, I found that you're not so interested in intraday trading. What do you think about
Sorry, interested in.
intraday? What do you think about intraday trading?
Um, but it's certainly not for me. Um,
Okay.
I think that there's quite a few difficulties in intraday trading, and especially doing it over the long term. I mean, if nothing else, it's incredibly stressful and time
Very.
consuming, and in my view, unnecessary. It's like kind of trying to run on a treadmill. You can put in a amount of effort and kind of not get much results. I think that there's a great quote. I forget who it's by, but he said like investing should be like watching the grass grow rather than trying to kind of speculate and trade every day. If you want to do that, you can do that. You'd probably be better off going to a casino, right? And kind of
Exactly.
money and enjoying yourself that way. But at the end of the day, in the short term, the market, we call it a random walk. I mean, who knows what the market's going to do today, tomorrow, the next day? Just nobody. So we can have a pretty good idea what it will be doing in 5, 10, 15 years time, because over the long term, markets generally do move up.
So, what do you think if a fundamental of a company is good? Fundamentals are really good. They're working so hard. So, what do you think in long term? It is surely going to give us a good result, a good percentage of result. What is the reason behind that? Why in the long term the game is safe?
So in my book, in the part of assessment, I describe a bit what I think makes a good company and the considerations you should look at. And I call this the court, castle, and moat approach.
Okay.
The court being management and the board, so looking at how capable they are, but also incredibly important, also alignment and accountability. So having management that are aligned with shareholders, perhaps through kind of ownership, or perhaps part of their remuneration is in stock options or shares. So they also benefit when the company and shareholders, minority shareholders, do well. And then accountability, in my view, is incredibly important for a company's management to be accountable to shareholders. So, for instance, having a strong independent board that can have proper oversight of
Exactly.
management, so that they do work in the best interest of shareholders. I think it's often forgotten that management are humans too, and very often they will want to do what is in their best interest, which very often is not very often, but quite often at least, is
Exactly.
not
Quite.
always interest of minority shareholders. So that's the court part. And then the other two parts are the castle. So making sure you have an attractive castle. So typically you would want a business with reasonably high margins, attractive business model, good growth prospects. And then the last part is the moat. And Warren Buffett talks about this,
Okay.
the different types of moats, that economic moats that you can get. And that's simply making sure that you're buying into a business that is sustainable, and you can feel comfortable will be there in 5, 10, 15 years time.
At
But
least.
it's definitely not the case for all companies.
Exactly. And what is your opinion on IPOs? Initial public offering. What do you think about that? Do you like to invest
Yeah,
on that or not?
yeah, no, absolutely. I think you can sometimes get some great deals in public offerings, but they're typically businesses that are less well known, and so sometimes they can be very mispriced.
Exactly.
That's not
Overvalued sometimes.
you can get some great opportunities now and again. That's not always the case. In a market that's done very well, a hotter market, sometimes you can get investment bankers that are perhaps a bit greedy in terms of how they try and price it. But broadly speaking, quite often I will try and look at an initial public offering because
Great.
sometimes they're a
Seems
good deal
pretty
as
good.
well.
My
Yeah,
experience was not so good on initial public offering, I guess. That
really.
recently
Yeah,
there was an IPO in 2020 September something like that. There was a offering of Burger King India. So I
really.
thought that's a very fundamentally strong and a well-known company in the market. I thought I need to invest in that. I was allotted 2 shares. I was requesting for, I don't know what was the band, but I requested for I got 2 shares, and it started with 300 Indian rupees, and it was always, getting stuck in upper stocks. It was going up and up and up for a week, I guess, and then suddenly overnight it came down, and now it is listed at somewhere around 150 rupees, I guess. I've not sold that. Still, I have that one. So my
Yeah, I'm sorry. But
experience was not so good.
when I hear stories like that, it does make me think kind of being able to value a company and know what it should be fundamentally worth. When you then get a stock that kind of does go up a lot, you can know when to sell it, or if it goes down immediately down after listing, then you can know actually this is a great opportunity to buy more.
Exactly. So at that moment, I did not think like this. Hopefully, next time in upcoming futures, I'm going to think about this and surely going to take a good decision at a point. So, is there any tools and some of the techniques to find out a good valuation, a value of company?
Yeah, so in the book, I just keep to the two basic ones that professionals around the world use, and that is either relative valuation or intrinsic valuation.
Mhm.
Relative valuation is saying you're looking at kind of similar assets with similar risk and opportunity profiles, and saying they should be kind of trading at about the same value. And it's a bit like when you go to look for a new property or you want to buy a property, you'll look at the properties down the street. Um, what you have to do though is you have to standardize the valuation because of course um, companies are different sizes. To do that, you use ratios. So, for instance, the price to earnings ratio or the price to kind of equity book value ratio, price to cash flow ratio. And what those does do is it makes a company comparable, kind of no matter its sector, its geography, its history. You're able to say
Definitely.
company trading with that, this one trading with that, or perhaps a similar businesses trading in the places. So that's the simplest way to go about valuing a company, and that's that. I mean that can be done very quickly if you use Yahoo Finance, Reuters. All of these websites are free and can give you kind of instant information on what a company's valuation multiple is. So that's relative valuation, and then there's second type of valuation, which is intrinsic valuation. This is a bit more complex, typically used far more by institutions than individuals because it's a bit more rigorous
Okay.
in the process. And to do the concept here is you're looking at a company's value as what it will generate for you as a shareholder. So the cash flows that it will generate.
Okay.
Um, so if you had a share in a company and you're only expected to ever get one cash flow from it of $100, in a year's time, you'd say, okay, that share is worth about $100. Of course, it's more complex than that. So you have to go and project out for a period about 5 years normally, and then you put a terminal value on that. It it sounds quite complicated. In practice, you can kind of create an intrinsic valuation in a reasonable amount of time, and it's certainly worth learning about. Because even if you don't perform intrinsic valuation, it's worth knowing kind of these forces that should affect the long-term value of a company.
The first technique was quite simple for me, I guess. As
Yeah,
you
I
as
can't
you
say
mentioned, that the second one is a bit complex. That's good.
yes, yeah. The first one, I often think about it because a lot of people will be looking at kind of the value of a house, for instance, in price per square foot or value
Mhm.
per square foot, and it's very much kind of similar thinking along those lines.
That's great. So I just like to know a small personal question. What was the longest period you have invested in a company? What was that longest period? Or it is
Oh,
still going on?
yeah. So some companies I invest in and I don't touch, and often that's the better way. Very often that's the better way to do it. If at the start you can do a proper fundamental valuation and have a good grip on what valuation is, um, often it's better to just kind of leave it if you feel kind of very comfortable with your investment thesis and that has not kind of significantly changed. I often tell people, a lot of people, kind of you shouldn't be considering and investing in something for 20 seconds that you wouldn't hold for 20 years. So taking kind of that long-term approach that I write about in the book, the kind of forecast and note approach, I hope that gets people thinking about the forces that affect a company 5, 10, 15 years out, rather than simply what it will maybe look like in 12 months' time.
Exactly. But if you just look at the younger generation like me, we are losing patience, getting out of the patience. We want to be millionaire by 1 year only. So that is the reason this type of things like swing tradings and intraday are getting quite famous in young generation like me. But actually, the power is hidden in investing itself. I understand that. Talking with you and other investors, they told me that, Vivek, rather than running behind this intraday and swing trading and whatever, let's go with compounding and all. These are the real magic. Exactly.
Yeah.
So
And
I'm understanding.
when you look at the richest investors globally, kind of how many
Mhm.
day traders are there? You don't say like Warren Buffett's not a day. And like all these guys, they make their money by doing the work early on, taking a view,
Exactly.
investing, and then holding it for a long period.
Rather than just buying it today and selling it tomorrow. Exactly. That is the reason,
Yeah,
sir.
I think
Recently,
and it comes back to
Mhm.
biases. Oh,
Please, please go for
sorry,
that.
Jan.
Please continue with that. Really sorry.
Right, no, I was just going to say it comes back to behavioural biases as well, because we're very much all driven by animal instinct. And as soon as you get into day trading, it's that you're not fundamentally trading, you're just trading around the news. And maybe you think you get an edge on something and kind of therefore trading that. It's just, you can do it when markets go up, they go up and everybody makes money. It's when they go down that you can get, especially during day trading.
Exactly. So, so that is recently the SEBI, the Security Board Exchange of India, that is a regulatory body for our Indian stock exchange. So they have created a new rule which is going to be applied from August of 2021. They are going to remove the leverage, or you can say the credit which we are getting for the intraday trade. They're going to completely remove that so that they can save the investors. So they want to just simply make the intraday and swing traders come in investing. They want to remove that leverage and all. So I guess that is a good decision according to me because a controversy is going on. So yes, that is some of the things the Indian governments are doing us to save the retail traders to lose their money.
Yeah,
So that
hopefully, and you can see why they'll do it. I mean, they're not doing it because they're nasty. They're doing it because if they encourage more long-termism in the Indian capital markets, um, it should be help protect the retail investors, but also it has benefits for broader society as well, and the allocation of kind of financial resources when you have a kind of well-priced equity market.
exactly because we cannot give a money to an entrepreneur, invest in their company in tomorrow and just remove it today and tomorrow. That is disrespecting that entrepreneur. Let us give some time and space time as well to work and grow and multiply our money. So that is the thinking which
Yeah.
I guess government are thinking about this. That's a good thing. So when did you become financially freedom? This term is very famous in youngsters right now. When did you become financially freedom? Sir?
Oh, good question. Then kind of personally, I was quite fortunate in that my parents helped me through university. I know it was after that that I became financially free. in that sense. But I mean, from the very start, as soon as I had spare cash to invest, I've been investing personally.
Mhm.
And I think it makes sense for a lot of young people. It makes most sense for the younger people in society to invest because you can invest over such a long time period. And yet frequently, again and again and again, you see it, the people that invest the least in society are the young people. And I get it because you don't have much cash when you're in your 20s.
Exactly. Yes,
Uh,
you're right.
so I entirely get it. But I do think of many people when you get into your 40s, 50s, you look back and you think, my goodness, only if I'd invested. It's just been like a kind of a dollar a week, even kind of the way it accumulates, it's so quick, especially when you include dividends. Because when you look at the share price chart of a company, that's only one form of return. Quite often, companies will be giving dividends as well. So you haven't got just a capital gain return, you also got that income return as well on top.
Listening to you, sir, I found a very important role in your life about dividend as well. So, what do you think? Are going to dividend pay us a good amount of money, or we have to invest it in a long term, and we have to get the fruit of our patience, or we can just hope for the dividend as well as a good amount.
Yeah, dividends are critical and like they're so easily forgotten as well. So if you look at emerging markets, if you look at developed markets, US, UK, Europe, dividends have accounted. If you look back at the chart for 2000, for instance, dividends have accounted for most of people's returns over that period. Um, and it's the income that companies pay to you. So kind of most companies will decide to give shareholders a dividend. Um, it's less common in India at the moment, and that's
Exactly,
because
it's very less.
reinvesting is often more attractive, and that can very often be sensible. If you've got really great investment opportunities, then look, absolutely, investing is preferable to repaying shareholders. But across a lot of companies, markets, China, Brazil, Mexico, Indonesia, US, UK, dividends is a large part of people's return, even when the payout is only 40% or so.
Yes, sounds interesting. In India, I was just recently checking some of the big companies' dividend paid in few 5 years. That was not so much. I was very unhappy by because they also need money. They also need to reinvest that money rather than giving to the shareholders. So exactly, they are planning something big for us. So we have to be patient at the moment.
Yeah,
Really?
yeah, no, that's it. It's quite interesting. You get very different dividend cultures across different markets.
Hmm.
Um, some places, even high growth markets, some like Brazil, for instance, they're very and across Latin America. Even though there are good investment opportunities there, you quite often get a dividend culture where they're still willing to kind of pay out quite considerable portions of profit to shareholders. Quite often that can help the valuation of a company as well, because the dividend's a very tangible form of return that
Exactly. Definitely.
shareholders like.
That's really good to know that. So, you have any experience about Indian stock market?
A bit. So I used to do emerging markets more broadly, um, and India was a part of that, but admittedly not a large part. But I think kind of the Indian market in general. I mean, I don't need to tell you there's plenty of very interesting kind of structural opportunities there. I think kind of the culture there, people are very dynamic, enterprising. It's, for investors love that. But it's also one of the more difficult markets. I know kind of one of the concerns people often have is corporate governance sometimes in India is sometimes questionable, and also sometimes some of the state firms as well aren't quite as shareholder friendly as you would perhaps expect from a publicly listed company. But in general, I think kind of India it's a very interesting market in the.
Very dynamic one, as you told. I'm very strongly agreed with this point because a lot of young investors are there in Indian stock market. So that might be the reason, I guess, according to me. And there is an interesting fact I like to highlight here. If you just look at the past 3 months or 4 months of data, you'll find that the number of demat and trading account created in this 4 months is larger than the last 4 years.
Really?
So I was shocked. I was just reading an article. I just got pop up like this. I read up and I was shocked.
That's absolutely brilliant news, though, when you have a society that's fully invested in the kind of companies there, kind of the democratization of finance, I call it in the book, and when you've got the people kind of owning the companies, I think that's a kind of very powerful and positive force in the society.
That's a good thing, people are becoming financially aware about the money, where to save, where to invest. That's a good thing. So, what are the suggestions you like to give? I guess we're coming up to the end of this podcast. So, some of the suggestions for me, like I'm 18 right now, starting my investment journey. What advice would you like to give me?
Yeah, I think kind of the most basic advice is um, take a long-term view of equity markets. And that's so important. And I wish kind of people had told me more that when I started out in my career, because there's
Okay.
things that I look back now and think that's obvious I should have held on to that. And yet at the time, you're kind of thinking all these things. The news flow is sometimes bad. You sell out and then it goes back up. And just trying to kind of go back to basics in terms of what are the forces that affects a company long term, what are the actually good businesses, being a bit disciplined on valuation to make sure that you're not buying into something that's a bit of a bubble that's trading at excessive valuations to defend your downside. It sounds like a lot of work, but kind of, it's the kind of thing, if you've got an afternoon, a day to spare, just really have
Exactly.
a look around and companies that business models that you like. I have a chart in here in terms of how to find good companies actually, and it's kind of what you're good in, um, what's your hobby, and kind of where their money is. So you probably won't be able to.
Ikigai.
Yeah, but being able to. I'll try and. I don't know if you can see that.
That's something like the one which the Japanese technique to find your career option. That's similar to this one.
Yeah, I imagine. But I think it's kind of good to just kind of bring it back to kind of what type of companies are worth looking at. Um, so if you look at Nike, if you love wearing Nike shoes, have a look at Nike. Maybe that's had a great valuation and a great buy.
Definitely, I strongly agree. If you're not interested on a company which you're investing, you're going to get bored soon and you're going to take your money out. So that's a good, you have a really nice chat. I'm going to look up to that as well. It's good to see you. Really nice to talking with you, sir. A lot of rich knowledge you told us, and hopefully many of the new investors are going to listen to your words and they're going to keep in their mind and start their journey very smoothly. That's really nice talking with you, sir.
Great to speak to that.
Thank you so much, sir, and hope to see you soon again in this channel. And thank you so much.
Okay, have a good day.
Have a good day to you as well. Thank you, sir.